Good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Okay, so anything said in this piece is an opinion only. It's not financial advice, not investment advice, and it's just there to broaden your knowledge. Okay, so let's kick off. Let's have a look at what was driving markets yesterday. Yesterday, the biggest factor driving markets was fear of poor results from the high-tech sector of Meta, Apple, Google, CRM, all of the high-tech sector that's reporting this week, corporate earnings, and the most important was rising interest rates. Let's just focus on that a little bit. Consensus of opinion is that interest rates in the States are going to rise by 25 basis points. So today and tomorrow you've got the FOMC meeting, a Federal Open Market Committee meeting in the US. That's the Fed governors all meeting to decide what's happening with the economy, where interest rates are going, and what's the forecast for interest rates. Okay? So global consensus is running at 25 basis points. However, there's a tiny percentage that could raise it by 50 basis points. Highly unlikely, but I'm going to go for that. I'm going to say that the Fed is going to raise interest rates by 50 basis points. Okay, I could well be wrong, and it doesn't really matter if I'm wrong, but I do believe that the Fed, Jerome Powell, who's hawkish, he's an aggressive inflation fighter, and he will raise interest rates aggressively in order to get inflation under control. And remember, in the States, in Europe, in the UK, inflation is stubborn. It's not really falling. Okay, undercurrent of inflation, the underlying furnace of inflation is still there, and it's likely to get higher. It's likely to go higher. Inflation is likely to rise over the next few months, especially as energy prices rise, and especially as the war in Russia and Ukraine intensifies, because Putin is not going to come out of Ukraine without a victory. That's for sure. First of all, gets a victory, then he'll colonize it, and then he'll withdraw from Ukraine. Okay, that's a bit of a geopolitical issue. Going back to the interest rates, you've got the FOMC raising interest rates by 25 basis points, and the market's very, very nervous. The high-tech sector, which is totally dependent on cheap money and low interest rates, is dehydrating. It's starving. It's desperate for a flow of money. There's not many deals happening in the high-tech sector because investors and traders who are going to get 3, 4, 5% return on their money are going to take that money out of high-risk assets, and they're going to put it into secure assets like bonds and like bank accounts. So the high-tech sector is going to suffer throughout 2023 with a lack of flow of money. Interest rates are not going to come down in 2023, contrary to everyone's opinion. They think, oh, by end of 2023 rates will start coming down. They're not going to start coming down. Rates are only going to go up, and I expect rates in the US in the first 6 months to be around about 5.5%. Yes, I'm talking about 5.5% in the US, and inflation to continue rising. Now, Jerome Powell and the Fed know this, so they could well raise interest rates by 50 basis points tomorrow evening. So keep an eye on that. That will impact, obviously, on the dollar. If it comes in at 25 basis points, that's already priced in. They won't have a big move on the market unless the statement is hawkish or aggressive. If the statement after the interest rate rise comes in hawkish and aggressive, then obviously that will impact further equity markets and foreign exchange markets. Let's move a little bit onto the high-tech sector, onto the NASDAQ, the big Facebook, Meta. What's going on there? So their shares have fallen off from $380 a share in January 2022 all the way down to where they are now, which is 146.5. Still far too high. So I'm calling Meta, Facebook, down below $100 in 2023. They're wasting huge amounts of money on this metaverse, this illusion, this empty vessel that they're just pouring billions into, and the hedge funds and the investors in Meta are not happy with this drain on resources going into the metaverse, which is going to go absolutely nowhere. Mark Zuckerberg has it wrong. Okay, not only did he steal the company when he started off with, he's now going into a venture which has just got zero future. The metaverse is not going to happen, and it's not going to bring profits to Facebook. Okay, so we need to be very clear about that. Facebook gets its revenue from advertising revenue. The advertising sector is contracting. The reason why it's contracting because they're cutting back on advertising. Those companies are cutting back on advertising or want to get better deals when it comes to them closing a deal with a host company like Facebook. Okay, now in a recession, as companies' profitability drops, their marketing budget drops, and therefore there's going to be more competition in the marketing sector. So companies like Google, okay, Yahoo, Meta are going to end up having a smaller margin, tighter margins when it comes to advertising. That's assuming that they get that advertising at all. They might not even advertise with them. It all depends on how the structure of that particular website and that host company can promote the client and get the business in. So Meta's profits are going to go down. Its costs are going to go up. They're going to lay off a lot more people. Probably another 5 to 10% of the workforce is going to go from Facebook this year. So you can expect news on that, as well as other high-tech companies are also going to lay off. So layoffs in the high-tech sector are going to continue throughout 2023. Just be aware of that. As far as Meta's concerned, you can expect, in my opinion, disappointing results again, and the shares are going to sink all the way to below $100, and that's without a correction in the Nasdaq sector. The Nasdaq is ripe to be sold off, and equity markets are far too high, and we could expect a 25-30% drop overall in equity markets. That would push all shares, and especially high risk assets, significantly down to real values of what they should be worth, not these ridiculous high valuations that they have at the moment. Going on to Apple. Apple's had problems with its Apple iPhone 14. So the Apple iPhone 14 has not sold as much as it should have done, and therefore that's going to impact on results with Apple. So I expect Apple to come out with pretty disappointing results. However, they're also going to lay off staff, and all of the companies are beginning to lay off staff in order to keep their bottom line or add to their bottom line, keep their costs down and make their profitability a little bit more. That could be a savior if they keep laying off staff. However, if they lay off staff, then you're going to have rising unemployment in the US. Rising unemployment would then lead to a greater and deeper recession, because there's less consumer money spending, less consumer spending around, and that will impact further on corporate earnings. So it's one big cycle, and we're entering that cycle in 2023 with a lot of falling prices, a lot of falling asset prices. Moving on to semiconductor chip manufacturers are down. There's a lower demand for chips, and therefore you're going to have all the AMDs and the Nvidias, all of them going down south. So keep an eye on the semiconductor chips. That sector is in a bear market, and will enter a bear market pretty quickly. And those chips are going down. Chips are off the table. As regards cryptos, Bitcoin came off significantly yesterday, following the rest of the high risk sector. Nasdaq high risk assets coming down, fell nearly $1,000, came all the way down from 23.8 down to 22.9. So you can expect Bitcoin to fall even further as the risk is taking off the table. All depends on where interest rates go as far as the States. European interest rates you've got rising on Thursday, expected 50 basis points, and also in the UK expected 50 basis points in the UK. Andrew Bailey will raise rates in the UK by 50 basis points. As far as foreign exchange is concerned, the dollar DXY index is just sort of hovering there. It's not really moving up. All depends again where interest rates are tomorrow. As far as the pound's concerned, you can expect the pound to keep on rising, and that's more or less it. The 10-year Treasury 3.55. I expected this year to be 4.55, continue rising with more flight to safety. This is Mayor Valensky with Driving Markets. You can catch me also on Instagram and also on TikTok. Subscribe, share. Hope you enjoyed. Pass a comment. Speak to you soon.